Computer Age Management Services Q3 and 9M FY23 conference call organized by Orient Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. We request all the participants to kindly refer to the safe harbor statement in the earnings presentation. I now hand the conference over to Mr. Anuj Kumar, Managing Director, CAMS. Thank you, and over to you, sir.
Hi, good morning, everyone, and thank you, Michelle. I hope all of you are able to hear me clearly. I appreciate all of you taking the time out to join our earnings call. As you may have seen in the results, we've had a satisfying quarter, and I have a number of things to share with you significantly in terms of operating highlights. As we continue to work in a business environment which had a set of challenges to deal with, I think the overall outlook for the quarter in terms of business results has been very satisfactory. I will run you through a structured presentation. Starting off, just in terms of our mutual fund business, you would have seen that we announced two new logo wins. These are always an important part of our overall endeavor to maintain share and relevance in the marketplace. Helios Capital, which is entering the mutual fund market through a new license, has chosen to join the CAMS platform. This decision came in the month of November. And then Navi Mutual Fund, which was an existing mutual fund, but under a new management after a takeover of an existing fund, has also chosen to select CAMS as their provider. So that's the good news on the new logo win on the mutual fund side. Overall, on the core business metrics, our AUM scaled a lifetime high of 27.8 trillion rupees, or just short of 28 lakh crore rupees. This came on the back of what I would call steady growth in equity AUM, which is, of course, the most relevant, best priced and profitable part of our business mix. That grew 6.1% quarter on quarter. And we will speak a lot more about mutual fund business as we move along. On the alternatives business, we saw another very strong quarter. We grew revenue and sales over 20% during the quarter. And our digital onboarding platform, which is CAMS WealthServ, continued to see sustained interest and a slew of wins in the marketplace. It has now crossed, as of end of December, over 60 signups. And we continue to see a lot of interest and momentum in the marketplace as we broaden our sales effort and outreach. On the e-insurance side, where all of you have been following the media and following the announcements, regulatory announcements in terms of a DMAT regime coming up and a mandatory KYC requirement for all kinds of insurance, I would like to call out two things. While that topic is progressing and we all continue to watch specific regulatory announcements, what we saw happen in the quarter was that in anticipation of a regime of compulsory DMAT, consumers voluntarily chose to join up this regime. So you will see, and although all of this is on a small base and we normally don't call out very stark comparison numbers, but this is a stark comparison number. Our e-insurance accounts, the new ones, at close to 5 lakh, almost doubled quarter on quarter. And similarly, our e-policies during the quarter crossed 5 lakh, and this also almost doubled quarter on quarter. So 3Q over 2Q was a significant growth, all on a small base, of course, but a very, very positive consumer-driven outcome in terms of consumers watching an announcement and then aligning their own behavior to take advantage of the very convenient regime that is about to come into the world of insurance. On the CAMS FinServ side, which is our account aggregator business, I think we continue to report positive news in terms of going live with several FIPs and FIUs. and continuing to win business. One of the things on the highlights I would like to call out is that CAMS has now pioneered the usage of account aggregator data for bank account validation, as you know, for any format of payment across industries, whether it is insurance, mutual fund, NBFCs, banks. So far, 1 rupee penny drop or a penny drop through IMPS has been considered a very convenient tool. This is the first time we are trying out account aggregator data to validate bank accounts. It's a nice beginning. It's the first experiment or usage of this use case, and we will continue to share with you as we scale this. We've also been the first one to go live on the account aggregator platform with pension data as an NPS CRA. As an FIP. Insurance companies, as you know, have started integration with the AA ecosystem. The mutual funds are beginning. So that, as the story completes, will herald an era of almost all kinds of financial services sectoral entities joining the account aggregator platform. On the overall innovation and technology side, again, a very strong quarter. Two highlights that I'll share with you, which you perhaps read about on our website and other media news. One is that CAMS won the Cloud Innovator of the Year award from NASSCOM. This was particularly in reference to our putting out a fully on cloud NPS CRA platform. And like we've said to you in the past, we were the first ones, and this has been acknowledged quite well by a very large industry body like NASSCOM. And then just deepening the trend of technology-led innovation, technology-led experimentation, tinkering, whatever word you want to use. We've gone live now with our FinTech Innovation Lab with IIT Madras. As you know, amongst the IITs too, for all of you who've been tracking, IIT Madras has perhaps got a place of pride in terms of doing industry collaborations and generally having interfaces which are very, very strong with industry. So as part of our overall CSR initiative, we've gone live with this lab, and we will have interesting things to report as we move forward and engage the brightest brains in the country, both from the faculty side, students and other participants, in bringing out services, conveniences, utilities, and perhaps products which will start influencing the lives of people that we want to influence. On the NPS side, we continue to retain the number 2 position, and you know that it is still not 1 year since we launched, just short of 10%, so about 9.2% market share. What's also happened is that we are now seeing subscriber addition not just through eNPS, which is something that I just spoke about, but our POP retail linkages, where a point of presence has retail traffic on their website, and that traffic starts registering with CAMS CRA. That process began sometime in December. We are seeing a build-out of volumes. Our consumer side continues to remain over 90%. So quite happy with the progress in all of these new initiatives that we've been sharing with you all through 2022. And I know all of you have been curious about when they become, I would say, heavy in terms of subscriber interest, B2B interest, and ultimately revenues. Moving on, just in terms of growth in overall AUM, which you know is basic core operating metric on which everything hinges in our industry. Despite the times that we are living in, where you know that there have been a set of macroeconomic factors all through FY22, nothing much changed in the quarter we're talking about. We've lived through those challenges. Also, we've lived through an interest rate regime that continues to scale interest rates to almost levels which are not very precedented in the recent past. Given that backdrop, which has not been very easy, I think our overall AUM growth has been satisfactory. We're now reporting a lifetime high of 27.8 trillion rupees. And like I said, this has largely been riding on a smart equity AUM growth, both year-on-year and quarter-on-quarter. If you see the numbers, you'll see almost an 18% plus year-on-year 6% growth number over the past quarter. Equity AUM at the end of the quarter was just shy of 13 lakh crore at 12.9. Also, I think a significant metric is, and I know all of you are watching inflows, our equity net inflow share has gone to 63.7%. Of course, we continue to watch this closely. as this number builds out. And I think one basic bedrock this is building itself on is the monthly SIP collections, and I'll just come to that. But I think overall at the foundational level, despite what we are seeing structurally, I would say these are very positive trends to look at. Similarly, on new SIP registrations, you know that a large part or a notable part of the industry participation now commences with SIPs. So a number of 37 lakh and 37 lakh plus has actually grown a little from first quarter to second and second to third, 37 to almost 38.3 lakh. I think that holding number growing about 2% every quarter has been a very good, so at about 38.3, that is the new SIP registrations. Net of attritions, etc., new live SIPs grew over 12 lakh. And I think...
sir, I'm sorry to interrupt. Sir, we are experiencing slight static on your line right now. So I'll connect you back, sir. Can I do that?
Yeah, sure. Do that, please.
Thank you, sir. Ladies and gentlemen, please stay connected while we try to reconnect the management again.
Hold on.
Ladies and gentlemen, thank you for your patience. The management line has been connected. Over to you, sir. Sir, please carry on. Continue. Sir, we are not able to hear you. Ladies and gentlemen, please stay connected.
भारतीय डाक विभाग आजादी के अमृत महोत्सव
Ladies and gentlemen, thank you for your patience. The management line has been connected. Over to you, sir.
Vishal, thanks. I hope there is no static and the voice is clear now.
Yes, sir. It's much better now. Please
Okay.
continue.
All right. So apologies, team. Maybe there was a blip in the line. I will just commence back where I'd left. We were talking about SIP registrations holding between first, second, and third quarters at a number above 37 lakh, growing about 2% from 1Q to 2 and 2 to 3. Net of attritions and net of fall-offs, live SIPs grew by about 12 lakh in the October to December period. But I think a very strong, steady metric is the 7,800 crore per month of SIP collections during the quarter. And this, as you've seen in our case, has continued to go up. Obviously, there are no certainties, but continues to go up by an average of 150 to 200 crore a month. And I think that's almost formed the bedrock of equity net sales in the industry. This number grew by almost 6%, slightly ahead of industry growth. Transaction volumes grew, you can see in the chart, again, a good measure of customer engagement. And I think when you see new fund offerings, and we're going to talk about two segments of new fund offerings, in equities, we had a 70% share of collections. In debt, we had an 86% share. So the two categories which really matter, I think both from a new fund offering and SIP collection and share of equity net inflow, those have been very steady metrics, leading to where the AUM has been. And I think, like I said, given the backdrop of the times, it's all holding quite well.
So, no.
Move forward. We spoke about the new initiatives. On MS Central, I think the trend of consumer participation and consumer satisfaction, that line is holding very steady. The apps have now crossed a daily login of 10,000. Of course, this number, our aspiration is to scale it significantly, several X times where it is. But at 10,000, it shows a good, a good index of consumer participation. And then when you see in terms of other value, which is not just consumers coming to the app, but consumers going to any other app or website and being able to access this information, MS Central has now got live APIs, absolutely live APIs, where you can pick up your combined account statement. This includes all your mutual fund data, and all means all. It gets you live API-based data from the depositories. Only the MM data, by the way, not the stock data, but that comes in both for your ETF holdings and MS holdings, and of course everything that is in the RTI records, the first of its kind. And then as that is live and as we continue to scale it, there is more happening on the financial transaction side and the non-commercial transaction side, where we are making distributor-based APIs live now. And that will then broad-base the usage of this utility to direct consumers, who come to the app and website directly, and to all consumers who may be using any other partner app or website, but will be using the data cached, and then the transactability through the financial transaction and non-financial transaction APIs. In terms of market share then, 68.3% market share, like we said, largely riding on a 6% quarter-on-quarter growth in SIP collections, 23% plus year-on-year. Overall AUM at 27.8 trillion grew for about 4.3% year-on-year, 2.9% quarter-on-quarter. And similarly, equity AUM, as you would have seen, continued to grow well, 18.8% year-on-year, 6.1% quarter-on-quarter. Other metrics, you've seen the transaction volumes. The SIP book has grown 20% annually, like I said. Very strong foundational metrics. The SIP book stands at very close to 3.4 crores, so 34 million. We processed 97 plus million SIP transactions. Live consumer folios, investor folios are close to 5.6 crore now, grew 13% year-on-year. And unique investor service are a little over 24.5 million, so about 2.45 crore. Again, grew 14% year-on-year. On the alternatives business, like I spoke when we were talking about the headlines, the AIF business grew 20% year-on-year in the third quarter. Almost 70 new AIF and PMS mandates won, so more than one per week during the quarter, just holding out the trend that we have faced or that we have experienced across almost the entire year, calendar 22. 60 funds have signed up for AIF and PMS digital onboarding to CAMS WealthServe. On Fintuple, we continue to make inroads with large ticket wins from marquee clients. And then on the Gift City, we are now scaling operations, and we are present in the Gift City operating with 7 signed-up clients. On the account aggregator, overall total 55 account aggregator and TSP wins, large, medium, small, all kinds, 20 in the third quarter. I spoke about the customer account verification that CAMS is pioneering across the industry through account aggregator data. And we plan to scale this and make it a lot more popular. We've been to all the major metros, engaging with the consumers, B2B connects of all kinds, in terms of holding events to popularize the AA concept across various use cases, including wealth management. And overall, over 18 banks and one life insurance company are live as financial information provider. On the pension side, like we said, we are the first to go live on the account aggregator platform with pension data. The IRDA entities are now initiating their integration journey. And then high volume cash flow based lending use cases using GST data are now beginning to become popular. And then we are building out capabilities and utilities to take all of that to market. On the CRA side, you would have seen the various numbers that we put out. I think the significant thing is over a 9% share in ENPS, continuing to hold the number 2 position in the industry. Commenced our entire journey on POP retail customer acquisition, so have taken about 7 POPs live and are beginning to get traffic from them starting in the month of December. And then I think from a innovation and transformation perspective, industry first features of CAMS CRA using CKYC data to onboard pension customers, and then UPI-based bank account verification. These are things which are being noticed by the industry, including the regulatory circles, and are actually being recommended to our peers for them to implement just like CAMS has implemented. On the CAMS Pay side, just from a product and markets perspective, UPI auto pay feature is now live with 7 clients, very popular, including for mutual fund purchases. We've gone live with Insta SIP, where a same-day SIP can be started by making a one-time investment and then setting up an auto pay kind of mechanism for the same day. And similarly, we've continued to scale various business features, including Insta e-Natch and giving out a business app to our B2B consumers for merchants and their customers to experience a completely frictionless journey in the dealings with CAMS Pay. On the CAMS rep side, we'd spoken about 2 things in the last quarter. One is KYC to become mandatory for purchase of any kind of insurance. That is now gone live, and we are working with partners and clients in order to be a large participant in that space. And then I think from a numbers perspective, from a consuming numbers perspective, I've spoken about a 2x growth from 2x to 3x in the number of e-insurance accounts that were opened, and in the number of e-policies which are brought into those e-insurance accounts. Like I said, stark, very nice growth numbers coming up a small base, but a good measure of what consumers can do by themselves even before there is a regulatory framework as consumers open these accounts and pull their policies themselves. We now have over 4 million e-insurance accounts, 5 million plus policies. On our AI-infused initiative to pay back unclaimed insurance amounts to consumers, we are now doing this for several insurance companies, started with a base of 750 crore rupees of unclaimed amounts, and then managed to spot the right claimants for about 135 crore and pay some money. So I think that product is now going quite well and will continue scaling in popularity, because finding the claimants of unclaimed monies, I think, continues to remain a priority for insurance companies. It is a priority for all kinds of financial entities, just to make sure there is transparency with respect to this operation. So that product feature has gone very well. I will pause here and then hand over to my colleague Ramcharan to take you through all the financial numbers, after which we'll be ready for Q&A.
Thank you, Anuj. So I will take the next 5 minutes to go through the financial numbers for the quarter. The revenue for the quarter, we ended at 243.57 crores. This was up 2.5% year-on-year and 0.5% quarter-on-quarter. As you know, the component of the revenue, there are 3 components. One is the asset-based revenue, one is the non-asset-based revenue, and the non-MF revenue. During the quarter, on a year-on-year basis, for the same quarter, our AUM equity grew 4.3%. We ended the quarter with 27.83 lakh crores, as opposed to we had 26.99 lakh crores in the same quarter last year. So there was a 4.3% up on AUM. The asset-based fee also tracked the same number. It was up 4.5% year-on-year, and we ended at 187.5 crores of asset-based revenue. The second component, the non-asset-based revenue, we saw a dip year-on-year, a sharp dip of 8.8%. This dip was mainly driven by the drop in transaction revenue during the quarter. and lesser NFO revenue during the quarter. The earlier year there were a lot of slew of launches that happened from an NFO perspective, and there was some amount of depletion from a miscellaneous application revenue. So on a year-on-year basis, there was a sharp dip in the non-asset-based revenue, but the asset-based revenue tracked the growth in assets. From a non-MF revenue on a year-on-year basis, we grew 4.2%, driven again, Aneet was mentioning about the smart growth that we are seeing in the alternate space, the AIF space. So driven largely by the traction we are seeing on the alternate investment fund sign-ups as well as revenue. We grew a non-MF revenue by 4.2% year-on-year. There was some amount of increase because of higher transactions processed by our payment platform CAMS Pay. However, there was some decrease because of the KRA, new KRAs coming onto the system. So KRA revenue was lesser than the earlier quarter. So on an overall basis, the summary is that asset-based revenue year-on-year tracked the growth in assets at 4.5%. The non-asset-based revenue grew, depleted in 8.8%, driven largely by transaction revenue, NFO revenue. And the non-MF revenue increased year-on-year basis 4.2%, driven by alternate investments and payment businesses. But on a quarter-on-quarter basis, the revenue increase was 0.5%, out of which the asset-based revenue grew 1.4%. The assets growth during this period was around 2.9%. So there was a reduction from the overall asset growth to asset fee growth in what we see in the current quarter, which leads to the question on yields, which I will touch upon later. And on a non-asset-based revenue, it was almost flat, just 1% quarter-on-quarter down, again driven by reduction in the transaction revenue. That kind of largely drove the small reduction in the non-asset-based revenue quarter-on-quarter. The non-MF revenue did not grow. It actually grew by 3.9% quarter-on-quarter. This was largely driven by some reduction that we saw on the payments businesses during the quarter. However, we see some sort of increase in revenue that is coming to us from the payment business in the fourth quarter. But overall, the non-MF revenue decreased by almost 4%, driven largely by reduction in the payments businesses and some amount of KRA business. From a yield perspective, we have already we consistently have guided that given the telescopic pricing and the sometimes the price discussions that happens with the customers, there will be a lag between the asset growth and the asset fee growth. Our long-term, medium-term trend has been between around 75 to 80% of the asset growth will translate as asset fee growth. Over the year and over the 9-month period, although we have seen stable yields, largely driven by the fact that although there has been some price depletion, this has been compensated by the favorable mix ratio that we got, because the equity mix has recovered smartly. It is around 46.4% for the quarter. So any price depletion that happens because of the reasons I mentioned has been largely compensated on a year-on-year as well as a 9-month basis by the mix. However, on a quarter-on-quarter basis, the equity component growth was less pronounced. It was 45 to 46% is the growth that we saw. And as we had mentioned last time, this year has also been the year where there are 11 to 12 of our contracts of the 17 customers came up for renewal, and due to various reasons, including COVID and various other reasons, they got bunched together in a single year for renewal. We are happy to say that all the contracts have been renewed, and the overwhelming majority of those have been rolled over with no price increases. One or two contracts which were long-term, which came up for renewal over 5 years, there is some amount of reduction that's happened. So all these, together with the mix impact, is contributing to what you see as stable yields on a year-on-year basis. However, on a quarter-on-quarter basis, we have seen the yield drop by 0.03 bits. That's the commentary on the yield I wanted to leave you with. We'll just move on to the profitability index and the matrices. As we had consistently guided, what we are aiming for is the EBITDA margin of 40% plus. And, in the current, and we have seen over the course of the year, the EBITDA margin has kept inching up. right? We had a first quarter EBITDA margin of 41.4. The second quarter was 43.3, and the third quarter finished up further to 44.5%. So we ended the quarter with an EBITDA of 108.32 crores. On a year-on-year basis, this is actually up in terms of it is down in terms of 4.4%. But we have seen an increase in margin profile in the course of the year as we progress from one quarter to another. We would like to remind you that this number also includes the entire expenses we are eating on the new initiatives, like the account aggregator, like the TSP business, like the MF Central business that we are launching, and the increased expenses that we are incurring from an overall cloud perspective for the various initiatives that we are running. So the investments in the new business during the quarter has not been slowed down. They continue to be incurred in terms of technology, in terms of platforms, in terms of licenses. As we have consistently guided, we feel that the revenue from these operations would start yielding results from the first quarter of next year. Till then, this is an investment phase we continue to incur, and we have not slowed down the investments for any reason in the last few quarters. Given all those things, we feel that the margin is a credible number of 44.5% for the current quarter. The PBT for the quarter is 97.94 crores, that is 39.1%, and the PAT is 73.72 crores, that is 29.4%. Again, 2.2% up quarter on quarter, but 4% down year on year. We ended the quarter with a cash and cash equivalent of 479 crores of cash in our balance sheet in terms of liquid funds, deposits and balances, and the return of net worth was close to 40%. The board was pleased to declare an interim dividend of 10.5 rupees per share in its board meeting yesterday, which has since been notified. So all in all, the quarter has been characterized by muted growth from an asset-based revenue perspective. Not much of a growth from a non-mutual fund perspective. However, due to the additional investments that we are continuing to do in the various initiatives that we are taking, including MF Central, Account Aggregator, TSP, CRA, etc., which we feel will bear fruit in the coming year, we were still able to maintain margins at a healthy 44+%. So with this, I kind of hand over the call back to Michelle. You can open it up for questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Avinash Singh from MK Global. Please go ahead.
Yeah, hi. Good morning. Couple of questions. The first one, I mean, of course, the large chunk of the revenue is tied up with.
Sir, I'm sorry to interrupt, Mr. Singh. There is a lot of background disturbance which is coming from your line, sir. I would request you to go to your quieter place and talk.
Yeah. Am I audible?
Yes, sir, you're audible. There is a lot of background disturbance, sir. We are not able to understand what you're speaking.
Yeah. Okay. So the question I was asking that, I mean, the lion's share of our revenue remains tied up with the mutual fund, and the other revenues are pushing up. So now, as I mean, you are getting more clarity on the other revenue streams. So can we have sort of the medium term, say, next financial year and the year after that, some sort of a revenue mix or expectation, assuming that, I mean, the mutual fund sort of industry remains distributing steady growth. So how this MF versus non-MF revenue mix is going to pan out? That's number one. And second, if you can help us understand, eventually the revenue model, if there is any MF Central. So we are my question. Thank you.
No, sure. So let me take that. I think you've heard us say in the past that we want to diversify our revenue outside of mutual funds. and scale it from current levels of 10% to, let's say, 20% of company revenues. There are 3 or 4 businesses that we need to work on and scale, and they all have, I would say, significant promise. The alternatives business is to an extent delivering that promise right now because it is scaling beyond company growth rates and to an extent beyond mutual fund growth rates. So that's a good trend to be at. Insurance, our expectation is once this announcement gets implemented and if we see deepening of the trend that we've just shown you, insurance repository could be in that space for the next few years. And then account aggregator could go that way. Again, like we keep saying that it is still perhaps slightly early days. But we are focused on these 3 businesses to scale beyond company growth rates and produce the diversification. Anything else that we may do on the inorganic side should only add to the overall trend. Is adding many more new products going to be the answer? The answer is no, in terms of how much we can invest on go-to-market and product build, and how much can we consume the teams in these pursuits. I think we have the right balance. Of course, the payments business is also there, and the payments business has scaled, 50% of the output comes from the mutual fund industry, the rest is diversified. So we think we have a fair mix of products, and we will continue sharing with you as the scale-up happens over this year and the coming years. But it's our absolute focus to grow these alternative businesses or non-mutual fund businesses faster than company revenue growth rate. On MF Central, you know that this is more constructed and designed like a consumer utility, and we've been building it all through 21 when we launched it towards the end of the year. We've nurtured it to the current size and shape all of 22, and we'll continue scaling it. Of course, right now we are not expecting that revenues will even equal costs. They will not. That may take another 4 to 5 quarters, 6 quarters to happen. But once we get to that point, I think it will be a good point where it becomes a self-sustaining property, maybe at the end of this year. That is an aspiration. Is that going to be a completely profit-focused, revenue-focused entity? The answer is no. It's more built like a public utility to just add a significant layer of convenience for the mutual fund investors, and I think philosophically that's the way we continue to look at it.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi everyone. Just a few questions. So firstly, could you, throw some light on, there is a lot of media talk again of, steady kind of re-looking at the expenses of the TERs for the industry, and, kind of talking about subsuming the brokerages and other element, DSP element also into the TERs. So effectively the yields for the AMCs will decline and possibly some part of it will be passed on to you. So in the revision of the contract that you have done, is there any clause wherein which kind of allows the AMC to renegotiate immediately, say the announcement comes in the next 3 to 6 months?
So Prayesh, you are right. There is this live topic, and it has the components that you referred to, which means are the components of the TER what is outside the ceiling. There are various components outside. There are some components like transaction charges, and for certain kind of cities, if you get consumers from there, there are incentives. So all of that is, it's public news, is under examination. What will happen, time will tell. We are watching it as closely as you are. Again, the only point I would like to underscore is that from a scope delivery perspective, we as RTAs have continued to expand the scope every year. We do more and more things, and I think that's evident to the mutual fund industry that we are doing more and more things for them. Is there any clause as a specific answer in our contracts that they can come and renegotiate, etc.? Of course, there is nothing like that. We are watching the space. We will see what the outcome is, and if anybody wants to start a dialogue, obviously we know that we have to defend our overall value position and we have to defend our charging, which we have done successfully in the past, as you are aware. But to answer your question, there is no specific clause like that.
Okay, great. Coming to the second question is actually on the margins. Now, you're mentioning that, in spite of the investments that you are making in the new businesses, the margins are healthy at 44%, and you really commendable job for doing that. My question is more on from Q3FY23, where, possibly some of these businesses start scaling up. Do you think that you will start moving your EBITDA margins more towards, say, 46-48% in that zone? Or do you think that you would retain some part of the profitability and invest in some other businesses and maintain the EBITDA margins at the current level? How should we start thinking about EBITDA margins for next year onwards?
So, Presh, I'll take that question. See, just as a quantification, I think you got a delta right, which is that we spend almost 1.5 to 2% per, on the revenue in these new investments, which currently do not have a significant top line or a material top line. See, the way we look at it is, and we will have to keep providing for the expenses from a wage inflation perspective, from a security perspective. Our software expenses, if you see the operating expenses for the current quarter, the bulk of the increase is because of the additional investments we're making on cloud, on platforms, on security, on various licenses, cutting edge technologies, on databases, tools, etc. So we do not see from our perspective that those investments would stop or decelerate in the next year. Yes, there will be welcome addition to the revenue in terms of the new initiatives. Again, the ramp up would not be dramatic over one quarter. We expect that the ramp up will be gradual over the next year. Having said that, from a margin perspective, I think we are comfortable with the margins and the guidance that we are giving on the close to 43 to 44%. In fact, early 40s will be a good margin for us to aspire for. We will continue to make the investments on people, technology, etc. So while the revenue from the top line will continue or will kind of help us, the investments will not slow down. So I don't think we should expect a dramatic increase in the margin profile from next year. What it will do is free up more resources for us to keep investing in the other initiatives that we have in mind. So the margins will continue to be range bound is our thinking.
Okay. Thanks for that. And another question is on the insurance repository business. Now, you spoke about the settlement of the claims which were not earlier settled kind of. Is that kind of an activity chargeable? And so my question is more broad-based as to what are the charges, what are the services that you are currently charging for, and what are the incremental services that can come through. And currently, what is the size of the industry, and what do you expect the industry size to be, say, when the actually norms get implemented?
Okay. So I'll again answer the question in two parts. One is our insurance current revenue has got two parts. One is the outsourcing business, which is the labor business where we work on various customer systems from a policy servicing perspective, from a persistency perspective. But the focus and the growth will be on the second part which we are talking about, which is the insurance repository business. The repository, the current charging model is that we get paid for a policy conversion, which is that a policy that's converted into demat or electronic, we get paid by the insurance company. Secondly, we get paid an annual maintenance charge, which is for maintaining that policy in our electronic platform. Thirdly, we get paid for the transaction revenue. The transaction revenue currently is limited in scope because, the scope of the IR as it exists today is limited to maintaining the master data and the policies. The plan is actually very deep. We plan to do various things, and initiatives have already started and getting implemented. In terms of enriching the platform to be a policy servicing and a insured servicing kind of a platform, where we are building in various facets, including the statements, the surrender value computation, in terms of other servicing requests, probably even claim processing. So these are rich in transactions and policy servicing, which will kind of give us additional transactional revenue going forward. This is the enhancement that's happening as we speak, which will probably take a quarter or two for it to get fully into revenue. But this is our scope. In terms of IR, specifically on policy conversion, I think all of us are aware of the numbers. In terms of the policies that are live and not dematted, people are talking about the 45 to 50 crore policies that could potentially get dematted, including those with the LIC if the regulation comes through. Now that's a big if. So we don't know what shape and form the regulation will take place. It is going through its own in terms of discussion papers and notes and committees in terms of how this will pan out specifically. Readiness in terms of infrastructure. IRDA is closely on the job and monitoring in all IRs, and we are also one of the committees which kind of goes through this. So we'll have to wait for how it pans out. But if and when it comes, in the course of the next year, we would expect that this will create a big market for policy conversion as well as the platform that we are building for policy servicing. The one new development that's happened is from January 1st, the KYC has become mandatory. So that we will start getting action on that in a quarter or two from now. Even the motor insurance policies would require a KYC, which are so longer not mandated. So there's a lot of happening in that system. We will take probably a quarter for all these things to settle down. But everything is tending towards a positive direction in terms of incremental revenue.
So Prayesh, I'll just add to this. Just think of it in two dimensions. One, think that when a mandatory demat regime comes, the 2 crore or under 2 crore policies in demat can scale to 50 crore, and that's a significant multiple in terms of scaling of an industry. Will that go through a bit of price shifts, etc.? Any industry would, but net of price shifts, it will get a revenue scale of several x times. Could be 10 to 20x. That's point number one. Point number two, just look at the way you deal with mutual funds versus the way you deal with insurance. You don't deal in the same way. Mutual funds have allowed you to, there are aggregator platforms, think of my CAMS or think of MF Central, where you can do everything in one place irrespective of who has sold you the insurance and who has manufactured it. You can do things in one place. That format is right now not available. The e-insurance account will herald that format. It's a significant consumer convenience, which will lead to, large-scale changes in consumer behaviors, because consumers know that behavior in other industries. Why will they not use it here? The question to ask is, will all that become a commercial activity? Will it be paid for? Will it help revenue scale, etc.? But I think those are the two broad themes I'll encourage you to think about and base your thought process on.
Great. Thank you so much for all these answers.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. We have the next question from the line of Sanket Godha from Spark Capital. Please go ahead.
Thank you for the opportunity. Sir, again, the question is on insurance repository. So in the mutual fund industry, means if a MF chooses one MFRTA, it is the 100% business given to the MFRTA business. So are you seeing the similar trends happening in the insurance space? So for example, if HDFC Life or LIC has chosen to open all the insurance accounts or e-policies, whether it will be one insurance repository or they will socialize it or giving it to more insurance repository. So just wanted to know how it is going to play out. And second, you touched upon the pricing, but just wanted to understand how the pricing, according to you, will change from the current level. Whether you will see a steep correction from current what you are charging, or you will see a marginal correction, but it could be a meaningful number from the top line.
So, hi Sanket, I'll take this question. So, from our understanding and what is prevalent from a market perspective is that there is no monopoly or one insurance company going to one EAA. Primary choice is with the insured person to kind of where he wants to link his account with. Failing which, I think the insurance companies would kind of allocate it. What we are seeing is that we don't see many cases where they work only with one insurance repository. It is definitely more than one. So we don't see this RTA kind of a one-on-one relationship from an insurance repository to an insurance company. So it's more spread out among multiple EAAs. Obviously, the primary, it could be the choice of the insured also to pick the EAA provider to whom he wants his account settled. From a pricing perspective, now it's probably high single digits in terms of what we do for a policy conversion. It is only natural that, for a given volume where we do 5 to 6 lakh policies in a quarter, to it was multiple crores, it's only be natural that we will expect a sharp depletion in the policy cost. It will not be marginal as in 5% or something like that. We expect it to be sharp, especially given that, we'll have to wait and see what happens to the biggest insurers, how they are going to join this market, what is going to be the architecture for them. But we would not be surprised if the decline is sharp and it's not just marginal 5% here and there. That's our expectation. But having said that, what this number will be, it's entirely demand and supply dynamics and the who is going to kind of opt for what EIR accounts. So that we have to wait and see. We don't know the exact indication for that. Probably a quarter or two from now, when there is more regulatory certainty on this in terms of the shape of the guidelines. As you know, they are being now upgraded from guidelines to a regulation perspective. That's at least the aim of the IRDA. So all those things get published over the next 3 months. We will have a greater clarity on what's going to happen. But it's only natural to expect that there will be a rate depletion.
Got it. But just from the market share point of view, the insurance repository, today we enjoy around 35-37% market share in the insurance repository. But as you rightly said, it is for the 2% of the entire policies dematerialized. So just wanted to understand that this number you expect to stay there even for the entire when it becomes for the entire universe, or you think there could be a natural depletion in this market share in a bigger pie?
So, as you know, there are 4 providers as of now who are doing these services, and 2 actually have similar market shares of 35+%, which is us plus one more provider.
Yeah.
Of the 4, one is not very active, at least until the last quarter, and one is kind of a lesser market player. Now, obviously, our endeavor will be to retain and, if possible, increase our market share on this, and all our efforts are going towards that. If we are kind of diligent on that and do our work properly, we do not see why our market share should decrease. Obviously, we are working to maintaining and increasing our market share. So, yes, obviously, it's going to be a hard-fought market, so we need to kind of work towards that. But I think all our attempts are being made to ensure that we either retain or increase our market share.
Got it. And the last one on the insurance repository. As you rightly said that from 1st January, all the non-insurance policies or all the policies, the KYC has been made mandatory. So I just wanted to understand the trend, whether it has been outsourced to insurance repository or insurance companies for motor or health are preferring to do it in-house rather than outsourcing to you people. So how is the trend today, and how do you think you will convince, if it is in-house, how you think you will convince the companies to move it out to insurance repositories?
So we have some value proposition. It could be tied up to your EA account opening, etc. So there are some strategies that we have thought about. It's very, very early stages, Sanket. So we have to see the trend is emerging, especially at the time of maturity. This will actually pick up, right? So it's just being introduced. We have a proposition from a eKYC perspective, KYC purposes, which we feel is very strong coupled with the EA account opening. We are going to the market with that. I think a quarter down the line, I'll be able to answer your question with exact details on what market is doing, because I think everybody is on a figuring out basis now. So we will have to wait for a quarter for clarity to emerge.
Got it. And last one, LIC, I just wanted to understand, because it's an elephant in the entire game. So LIC is thinking to do it in-house, either the e-policies or they are open to outsources to the repository industry.
We have no concrete information on that. As I said, we'll have to wait for more clarity to emerge from a regulatory perspective, what the shape of the guidelines is going to be, regulation is going to be, and how they are going to react. So I think it's premature to speculate on that, and we have no concrete information on that.
Got it. Perfect answer. Thanks, Tom.
Thank you. The next question is from the line of Frederick from Sundaram Mutual Fund. Please go ahead.
Hello, sir. Thanks for the opportunity. Sir, my question again is a continuation of the earlier participant. So, the insurance repository revenue currently, what is that for us?
So, we have insurance repositories, the overall including outsourcing. We don't give a full figure, but I will tell you, insurance repository, if you do 6 lakh policies, you know what their approximate realization will be. On an overall basis, the insurance vertical for us is around 4 to 4.5 crores a quarter is the revenue.
Okay. and this can go up to 10x, assuming that we maintain our market share and a majority of the policies come to the insurance repository. So that's the direction we're looking at, right?
So let me just clarify, this is the insurance vertical. So out of it, there is outsourcing as well as the repository revenue. Repository revenue will be, for a quarter, will be around less than 1 crore rupees. So that's the component of this. In terms of growing 10x, again, this is obviously, we are looking at a positive uptick to this revenue. How dramatic that is going to be, we'll have to wait and watch. But we are very positive that this is going to be a reason for us to show increase in revenue definitely in this vertical. Given that we are well positioned, we are 35+% market share. We've been in this place for 7 years. We have the IT backbone ready. We have the IT infra ready. We have the connects with the customers and insurers ready. So we are very hopeful that this will be a huge uptick in our revenue. But everything is dependent on how the regulations pan out in terms of compulsory demands.
Got it. That is very helpful. The other question again is, sir, on the TER cut. So, how was it last time when the TER cut? Did the AMCs approach you immediately after the regulations came in, or you did have the existing contract going on for some time? So how did it happen last time?
The last time when this happened in 2018-19, you may have seen that a number of leading AMCs made a public statement that they believe they will reset the larger components of cost, largely connected to sales and distribution. In that year, if you see historically, any impact that we took was very, very small